Welcome to FounderLine, the show where we answer your questions about startups. I'm your host, Joe Beninato. Thanks for joining us. It's great to have you all with us. Our goal with FounderLine is to provide a forum where people who are interested in startups can get their questions answered by experienced entrepreneurs and investors. So maybe you're a founder who's thinking about starting a company. Maybe you're a founder who's in the middle of the company and you have something going on that you want to talk about. You might be an employee who's thinking about joining an existing startup. In any of those cases, we're here to help and answer your questions. There are multiple ways to reach us, and this is a live show, so we need your participation. The first is by phone. Our phone number is 1-844-4FOUNDER. That's 1-844-436-8633. You can also email us. The email address is help@founderline.com. And you can tweet. Our Twitter handle is @FounderLine. With that, let's get started. Our guest today is Manu Kumar, who's the founder of K9 Ventures, micro VC in Palo Alto, California. He's an investor in companies like Twilio, Lytro, and Zimride, which is now Lyft. Manu, thanks for joining us today. Welcome to FounderLine.
Thank you for having me, Joe.
It's great to have you here. Usually, when we get started, I like to spend a few minutes just asking you questions, warming you up, so the audience can start to know you. So you're an entrepreneur at heart, and you started K9 about 6 years ago now, right?
5 years ago.
5 years ago. And why did you start the firm, and what types of companies do you look to invest in?
Sure. So actually, it started out by me helping what is now Lytro.
Oh, really?
So while I was doing my PhD at Stanford is when I started helping Ren, the founder of Lytro, with getting the company up and going. And in 2007, we went up and down Sand Hill Road to try and raise a little bit of money for the company. We wanted to raise less than $1 million at that time. And when we went up and down Sand Hill, it was hard to find anybody who was writing a check less than $1 million, less than $3 or $4 million at that time, right? So there was nobody kind of doing that sub-$1 million segment. And the other thing that I noticed from that experience was that here's a guy who had built amazing technology, had the best thesis award from Stanford, had an ACM dissertation award, and most of the VCs were still not willing to take technology risk, right? Because they wanted to see finished product.
Yes.
They weren't willing to take something that was like, oh, here's awesome science and technology, let's now commercialize it and convert it into an actual product. So that was the second observation. And the third observation was that most of the people on Sand Hill, kind of the new blood that we met over there at that time, they weren't people who had actually founded or operated their own companies.
Yeah.
Right? So those were kind of like the three things that I noticed back in 2007. And it was like, well, that's a problem. And while it's a problem, it's also an opportunity. And it's an opportunity to create a new type of fund that is focused on that sub-$1 million type of financing round. It is focused on doing like core technology type investments.
Yep.
And it's like I've been a founder many, many times. And so I want to be able to kind of work with other founders the same way as if like when I was a founder. So
that's great. And so for these companies, typically there's a technology component. Is that right?
Yep.
And so Lytro was research out of Stanford.
Right.
You probably have a bunch of other examples, but that's one of your main criteria for investing.
So I describe K9 as a technology-focused micro VC fund.
Okay.
Right? And that's kind of my core, is that I really like new science, new technology type stuff. That really comes from a more fundamental belief that I want to invest in things that are new. And newness and novelty occurs in basically three forms, right? One form is new technology, which is the most common form in which something can be new. The second is a new market, right? And that happens less frequently, but it's also an interesting form of novelty, right? And the last one is a new business model, which is very rare to actually discover a new business model.
Sure.
Right? And so my focus is really on the first two, which is new technologies and new markets, right? And that's how I look at my investments as well, right? So we talked about Lytro. That was fundamentally new science and technology. I have other, like Twilio is a brand new technology platform for doing messaging and communications.
Right.
If you look at Occipital, that's a company that's doing, it's a 3D scanner for the iPad, right? You literally can walk around with your iPad and scan the whole room or scan the mug and hit print and it comes out of a 3D printer.
Oh,
right?
wow. That's very cool.
And then there's Coin, which is the kind of the universal credit card where all your cards are on a single card. And so all of those are kind of examples of like core technology type companies.
That's cool.
And then on the new market side, Lyft is a new market company.
Right.
So yes, people were sharing a ride with each other even before Lyft existed, but now it happens at a whole different scale, and that's the interesting part of that market. So,
all right.
Yeah.
That's great.
So,
and you know, in this time period since you've been doing this, the seed market for investing has really evolved, and it continues to evolve pretty much daily, right? So so maybe walk us through, you know, how you've seen that change since you started K9 Ventures to, you know, where we are today.
Yeah, that's actually what's been most fascinating to me is how quickly things have been changing in that space.
Yeah.
It's almost been every 2 years.
I know.
Right. So in 2008. It was like there were very few seed stage investors, right? It was probably like First Round and Floodgate were kind of like the two kind of major ones that were out there at that time. But there wasn't a whole lot more in terms of happening in the seed stage. But there were a lot of people like me and others who were observing that there's a void in that space that needs to be filled, right? By 2010, it was like everybody wanted to start doing seed rounds, right? And it wasn't only the seed funds that were doing it, but all the big VCs also started getting active in the seed stage, right? So it was kind of like this crowding of the seed space, like both from top down and bottoms up, around 2010. And then in 2012 is kind of like I would call that kind of like the defining year of the institutionalization of the super angels. Right. So a lot of the people who were the super angels between 2010 to 2012, they went off and raised institutional venture funds, small funds, so micro VC funds, but they're now truly VCs because they're managing other people's money.
Yep.
Right. And then in 2014, it's a different environment altogether because these funds became institutionalized, the size of the seed round has grown. Right, so a seed round in 2011-12 was maybe 500,000.
Right.
Today, it's not unusual to find a seed round that's 2 million, or sometimes even slightly higher than 2 million.
Right. For the same exact
thing. For the same exact thing. Right. Yep. And so I actually say that now, and I did a blog post about this a while ago, that I'm now a pre-seed investor.
Because you want to be in
because I want to be the first
$500K.
money in. I want to be in that kind of like the sub $500K, sub $1 million type of a space. So I'm a pre-seed investor, and then the seed rounds happen after that, and then the Series A. And really the nomenclature hasn't adjusted for what is really happening in the space, right? So the pre-seed is what used to be the seed. Right. The seed today is what used to be the Series A, and the Series B is what used to be the Series C, and so forth. So it's just like everything's kind of shifted a little bit. So
yeah, it's hard to keep up, and even with AngelList and some of these other the crowdfunding mechanisms, seems like if you need to raise money, there are ways to raise money. You still need to have a good idea and a good team and all that sort of stuff. But and
it's amazing that and I always say this, that entrepreneurs must think that VCs and investors are completely crazy, because a lot of us keep talking about how there's so much money at this stage or that stage. At the same time, for anybody who's trying to raise money, it's always difficult.
Yes.
Right?
Yes.
So it's just so one view is coming from the macro perspective in terms of like what's the total amount of money at a particular stage.
Right.
And the other view is coming from a micro perspective in terms of like, hey, I'm trying to raise money for my company, and that's being really hard.
Yes.
So,
No, it makes sense. Well, and you usually you meet these companies at the earliest stages. Sometimes like with Ren, where it was technology, there's may be no team or no product even. So when you're deciding to invest at this pre-seed stage, what are the things that you're really looking at?
So in a lot of cases, I end up engaging with teams before a company is even formed. In fact, in a lot of stages, a lot of times it's when even the idea hasn't been fully formed yet. I'll give you an example. So one of my portfolio companies is a company called Tangible Play that creates this product called Osmo.
Sure.
And so the founder, Pramod, he and I started talking almost 9 months before he even incorporated a company. Right, and so he was just like tinkering and building prototypes, and he and I would just keep meeting up and talking, and then ultimately I think I had to give him an ultimatum, like, come on, dude, are you going to incorporate and actually take my money or not?
Oh wow!
So yeah, and it was
the idea at that point was similar to where they ended up, or it was.
It is very similar to where they ended up.
Okay.
It certainly evolved in terms of the interaction and the design and stuff.
Sure.
But yeah, the core idea was kind of gelled during that time.
Cool.
And that's just one example of like where it was like before the company was formed. I'll give you another example. A company called Locomotive Labs. I actually found an app that the founders of that company had built as part of a previous company, and I just really liked the app, and I was using it for my daughter. So my daughter was playing the app when she was about 2 years old, and at some point I was going to refer another parent to like, hey, you should go check out this app, and I went to their website and I saw that the company that they were part of was shutting that project down. And so I actually reached out to the team. I'm like, hey, I really like the app that you built. What are you going to do after this thing gets shut down? And again, it was about almost 9 to 12 months before they eventually founded a company, and I ended up seeding that company as well.
Oh, cool.
So super early. The best description I've heard is frighteningly early. Okay. And you asked, what do I look for at that stage?
Yeah.
There's very little data. There is no traction at the time at which I'm investing in the company, right? It's typically like it's an idea and a team as the two things that I'm looking at. I do put a lot of emphasis on the team. So it's really a team that I can feel comfortable with, that I actually want to work with. And just like people who, like and from their past history, they've kind of demonstrated that they're doers, right? That they're that's important.
Sure.
Right? And then the second part is kind of an emphasis on the idea, right? So is the idea something that I can truly get passionate about and I can get excited about working upon? Right?
Yep.
And it's not only about is the idea a good idea. It's also about can I personally get excited about that idea, right? And there have been several cases in which like I've met with teams and they have an idea which feels like, oh yeah, this can make a lot of money, but it's just not an area that appeals to me.
Yep.
Right.
Founders sometimes have a really hard time with that one because it's like, what's wrong with me?
Yeah.
And I tell them, it's like falling in love.
Yeah.
You have to, you gotta. This is something you're gonna spend a lot of time on. You gotta want to spend that time, right?
That's right.
And yeah, you might be worth $1 billion someday, but if I'm not into sports, you're probably not going to get your sports site funded by.
And I'm not into sports.
Yeah, so there you go. So
yeah, if you've got a sports site, that's not going to fly with me.
Okay. Well, now we know what not to send to you.
Or advertising or e-commerce, like those are just not my things.
Yeah.
Right? So.
No, that makes sense. And the other thing that's really important is that founders who are looking for money do this research and know, like now they're going to know you're not into sports, or they're going to see, oh, why isn't he invested in e-commerce, or whatever it is. So make sure you do that.
And I do try to kind of be very explicit about like what are the things I look for in companies, and I'll give them really quickly. So I typically only work with technical founders, and I want a founding team where at least one person is capable of being the CEO. Right? Second is that new technology, new market criteria.
Yeah.
Third is I look for companies that have direct revenue. So no advertising, no media, no content. Fourth is that I want it to be capital appropriate. Right? And I used to say capital efficient, now I say capital appropriate, and the subtle distinction between there. And then the last one is I actually want the entire team to be based here in the Bay Area. And that's got nothing to do with me being here in the Bay Area, but it has everything to do with my belief that there's something about the Bay Area that is just amazing and very hard to replicate elsewhere.
Yep.
And geography is a very simple thing to fix in the big scheme of things when you're doing a startup. So,
all right.
Yeah.
And maybe one final question before we start taking calls and emails. But so Apple, obviously had some big news this week, and I think it's fascinating to watch this annual event that we all pay attention to, right? iPhone 6, the watch, and the Apple Pay, which is pretty cool. So what's your take? Have you signed? I guess you can't sign up for the phones yet if you want to,
tomorrow.
but tomorrow, tonight at 12:01,
yes.
right? I'll be staying up to order mine, so I'll be ready.
Yeah. No, it's fascinating. I always kind of describe actually both the Apple event and the Google I/O event end up being kind of like mini earthquakes in the tech ecosystem.
Yeah.
Right. Things get shaken up, and like sometimes they will end up incorporating stuff into their products, which end up killing other companies. Right.
Absolutely.
And that happens almost in every one of these types of announcements. But the thing that's kind of most fascinating to me, especially in watching Apple as a company, is that consumers' expectations of how a product should work is basically being set by Apple, right? So they're basically raising the bar on what people expect. And if you're a tiny little startup, you need to kind of that's the bar that you need to meet in order to have a good product and a successful product.
Yep.
Right?
Yep.
And that's really hard to do. I mean, here you have Apple, that's like the single largest tech company on the planet, with gobs and gobs of money, and big teams to be able to do things. So just a lot of resources. And on the other hand, you have like little tiny startups where there might just be like 4, 5, 6 people, and they're trying to launch either a hardware product or a software product, but the bar is just really high.
Exactly.
So that's and then in terms of the actual announcements that Apple made, on the phone, I feel that it's basically incremental improvements, which are kind of expected, like bigger display, better display, better camera, and all that type of stuff. So nothing that I would say that there was like groundbreaking, but very expected and welcome. Right? The watch, I'm very anxious to try. I think they did a phenomenal job on the design, and just the attention to detail is what kind of is mind-blowing to me.
Yeah,
it's
like those straps and everything. Like you kind of take watch straps for granted, but now there are all these magnetic things which nobody's really played around with. It's almost like they had a whole separate team on that, and the fact that you can interchange them if you need to. So that was pretty well done.
Yeah, so that was very cool. And then Apple Pay is fascinating, and it's something that I was expecting, and I'm guessing a lot of other people were expecting Apple to do years ago. Yeah. Right. No, I was. And in fact, when the iPhone 5 came out and it didn't have NFC, I was kind of very surprised. And I was kind of banking on iPhone 5 having NFC, and in fact, I'd invested in one company assuming that would be coming, and I think, but Apple was probably wise to wait to do it now as opposed to the 3 or 4 years ago or 5 years ago. Yeah. Because the problem there is really about how many merchant terminals actually will accept NFC. Exactly. Right. So that's the big issue. And yes, they've certainly done a lot to kind of show like, oh, there are all these merchants who will be accepting it. So that's great. But it still has a problem, like it's only iPhone 6. Correct. Right. So my iPhone 5 is not going to do Apple Pay, right? It's NFC based, so only those places that are NFC enabled. It still doesn't solve the problem of when you're at a restaurant, how you're going to use Apple Pay at the restaurant. Are they going to bring the terminal to you? Are you going to give your phone to somebody? Right. So there's just still a few things that need to be figured out there. So yeah, but I think it is the way things are going to be in the future, but it'll take some time to get there. Well, what I always find fascinating is they wait
but when they do it, it's actually a really interesting time.
They do it well,
because a lot of businesses are going to be upgrading those Verifone terminals because of the pin plus
because
chip stuff.
The EMV, chip and pin.
And so it's kind of like, and then they have such power that they can get all of these big names on board, right, and say we are supporting this. Because I used to go to the Pete's on University Ave, and with an Android phone that had NFC. And use Google Wallet, and like they'd have to pull the thing out and dust it off because like no one else would use it, right? And it was and not that Google doesn't have that same power, but I think when they do something like this, I'm surprised it didn't leak out more sooner, because it was only like a couple weeks before that you started hearing the little rumors, but. Anyway,
but I think the other thing that was fascinating to me, like as an investor and watching startup thing, is like the power of business development. Right? That the sheer force of power that Apple has for doing deals with all the banks and the merchants and all this stuff, like that's an amazing power as well.
Not just one, but like Visa, MasterCard, and Amex, right? They get all three of them, and I don't even know what the deal is, but anyway, well, so we should probably answer some questions instead of yammering on here, but. So let's see if we can help some people. I'll just remind everybody once again, if you want to call us, 1-844-4FOUNDER. Email is help@founderline.com, and you can tweet to @founderline. So let's dive in. We have an email here from Gaurav. What was an instance that you recall where you had to be persistent to get a deal done or hire someone? How did you handle being persistent and not being a pain in the neck at the same time? I'm pretty sure he said neck, so I can't guarantee it though.
So that's actually a great question, because one of my favorite quotes and one of my favorite lines is the definition of entrepreneurship that was given to me by one of my mentors. And that the entrepreneurship is insane perseverance in the face of complete resistance. Okay. And so so persistence really does matter.
Absolutely.
And I'll give a small anecdote of how I actually use that in getting started as an entrepreneur. So when I decided I wanted to start a company, so at this time I was still a total geek and nerd in the computer science department at Carnegie Mellon. And I decided, hey, I want to start a company. And so I figured, I know nothing about starting a company. Maybe I should walk over to the business school and try and see if I can take an entrepreneurship class. Right? And so I poked around and figured out who the professor was, whose class I wanted to take. And then I went to the professor and said, hey, I'd like to take your class. And so he said to me that, look, the class is only meant for business school students, and it's already oversubscribed, so there's no way you can take this class. Okay. And I just didn't take no for an answer, and I showed up at the first day of class, and I kind of like stood right in the back, like in the corner next to the door, so that in case I get kicked out, I have easy access to the door. And the first slide, this is Jack Thorne is the name of the professor, the first slide that Jack put up is his definition of entrepreneurship: insane perseverance in the face of complete resistance. So I sat through the class, and right after the class, I walked up to him and said, Jack, you've already told me how I'm going to get into your class. It was on your first slide. So either you can let me take your class, or I'm just going to keep showing up and you'll have to call the cops to get rid of me. Okay. So that was my first kind of lesson on entrepreneurship and persistence. And yes, it does sometimes take kind of irrational persistence in some cases in order to actually persevere as a founder. So
that sounds great. Well, Gaurav, hopefully that's helpful to you. And sometimes you do need to be a pain in the neck, but people perceive that as, wow, this guy is not giving up. He really wants to do this. So, all right, we have another one here from one of our regulars, Larry from Yuba City. The question is, as your company grows, you don't always know everything that is happening right away. For example, in one startup, inappropriate behavior was permitted to continue for several days because the subject of the behavior was uncomfortable to discuss. Do you have any suggestions for identifying time bombs in the making before they go off?
So great question. I've actually been in that situation myself, where there were things happening in my company that I wasn't aware of, and other people they knew about it, right? And I was kind of like the last one to find out.
Yep.
And that's very much the case when you're, especially in the position of a CEO, right? Because the news kind of travels more slowly on its way up, and kind of sometimes doesn't make it all the way there. I think the ways that I like to address this is kind of like having ears and eyes kind of at the ground level. That you need to have kind of the open door type of an approach, where if somebody does have an issue, they can come to you right away. Mm-hmm. But even more than that, it's you need to have people that you trust and that they trust you, who can come and tell you that, hey, this is going on and it really shouldn't be going on, right? Yep. And they have to address that. Yep. So it comes down to company culture in my mind, right? And culture of the company stems from the founder and from the CEO. And I've seen this so many times that you can almost kind of like predict what the culture of the company is as a reflection of the CEO, yep. Right? So if the founder and the CEO is good about realizing that they need to allow people to come and communicate with them, then the company will have that culture. But if the founder and CEO does not have that, then you're kind of in a tough spot. So.
All right.
Yeah.
Sounds good. All right. This one is an anonymous message from mm-hmm. a tech founder is mm-hmm. the name. Mm-hmm. Every investor says the best way to reach them is through their network. Mm-hmm. What is the best way a founder with engineering background who does not have a network start building their network that will vouch for them? Obviously, mm-hmm. assuming they have a decent product team and traction.
So
you probably see a lot of this, right?
I do, and I'll actually, again, answer it with an example from my own background. So I started my first company in Pittsburgh, Pennsylvania. Yeah. And I was in Pittsburgh because of Carnegie Mellon, which is an amazing university with amazing talent, right? And at that point, I basically decided that, hey, I have all these connections into the university. I have a strong network. I can recruit people. I know the professors. And so, yeah, it's a good idea for me to stick around. What I didn't realize at that time, and what I realized only like 10 years later when I moved out to the Valley, is that the network here is extremely fluid, right? And people are very willing to help and connect people.
Absolutely.
Right? And so if you basically say that you're a great technical founder but you don't have a network, to me that's an opportunity for you to actually build your network and demonstrate that you are resourceful enough to do that, right? And if you are not resourceful enough to do that, that's a red flag for me as an investor. Right?
Got it.
So yes, you truly do need to build up that network, and the best way of doing it is to go to, like, you can even go to a couple of like startup events, meet interesting people, and you just kind of start working the connections from there, right? And ultimately you will kind of build up enough critical mass around it that you will know how to actually reach people through the network. So,
absolutely.
Yeah.
No, I think that's great advice, and it's really critical to do that because it pays. I'm always amazed by something that will find me from a half-hour meeting I had with somebody 6 years ago, right? Yeah. And so you just never know where that's going to come from.
Yeah, and that and it goes back to the first question around persistence, right?
Yeah.
Like if you're going to be an entrepreneur, you need to be resourceful and you need to be persistent.
Yep.
Combine those two together and go build your network. So
sounds great.
Yeah.
All right, here's another one from Adam. I recently moved to SF to grow and accelerate my startup. I am wondering what is the best way to make friends with advisors and mentors who can help me raise in SF and the Valley. Raise money, I assume, in the Valley.
I think the answer to that is the same as the previous question.
Yeah,
it's all about networking. You need to kind of build up the network, show people what you are doing, and if people like what you're doing and what you're building, they will be willing to help you with it.
Yeah.
So. Yeah.
And I think in a case like this, you want to find some core group of people who believe in you, right?
That's right.
And I occasionally get these requests from people like, you don't know me, but can you introduce me to so-and-so? And it's just like, what good is that going to do? Like, they're going to be like, how well do you know this person?
Exactly.
Oh, I never met them before. And they're going to think I'm an idiot and you're a bigger idiot, right? So I think it's sort of like building this, core around you, getting a good lawyer, some advisors, whatever, to help you out as well. So, So Adam, hopefully those two questions, will help you out a little bit. We've got another one. We'll do one more, and then we'll do a little work for our sponsors here. This one is from Michael. It says, from your website, when you choose who to fund, you appear to focus less on referrals than other VCs. Is this correct? And if so, why?
So if it feels like I focus less on referrals from the website, that's probably not the right perception that I want the website to give. Referrals are super important.
Well, some VCs say, I will not talk to you unless you are referred by somebody I know.
Which is also what my contact page on my website says.
Oh, okay. Okay, there you go.
It's the same thing.
All right, Michael.
But I do rely a lot on how those 5 criteria that I described.
Got it.
I do follow those fairly diligently. And so I do try to make sure that I filter the deal flow based on that. And in fact, I publish those 5 criteria on my website. And the reason for publishing them is that I want founders to be able to self-select as to whether or not I or K9 would be a good match for them.
Got it.
But referrals do matter. Most of the deals that I have ended up investing in have come in through one kind of referral or another. The best referrals are referrals from other founders, right? And referrals from VCs are not as good as referrals from founders.
Why do you say that?
The only time a referral from a VC is any good is if they've already committed to investing.
Okay. And even then, that's not always the case.
That's right. So I would say referrals from other founders is the best way of actually getting through, and or like even employees of other portfolio companies is a good way of actually getting through. So
all right, sounds good. All right, well, we're going to take a moment now to thank our sponsors, and this show wouldn't be possible without the support we get from our 2 amazing sponsors, Orrick and Ustream. First, I'll start off with Ustream. I really would like to thank Brad and his team over there. When we first contacted them about FounderLine, they thought it was a great idea, and they've been very supportive throughout. Whenever we've had issues that we needed to understand and look at, they've always jumped right on it and helped us out. When we went to Europe to do the show remotely, giving us some advice on that as well. So if you're thinking about doing some live streaming, whether it's broadcasting a meeting or whatever it might be, having some sort of live event, you should go and find out more about Ustream because they're the best. You can find out more. Go to their website. It's ustream.tv. I also like to thank Orrick, and Mitch Zuklie, who's the chairman and CEO over there, is a good friend, and we've worked together on multiple companies. And once again, when we first started talking about FounderLine, Mitch thought it was a great idea and even offered to come on the show regularly to help out and discuss legal issues. Unfortunately, he's out of town this week. But I always tell founders that one of the most important advisors you can get to help you out is your lawyer. Yes, they do your legal paperwork and incorporate you and process your employment documents and financing documents and everything else. But more importantly, they've seen so many more examples of hiring and firing and financings and business development deals and acquisitions than you'll ever see. They can apply that knowledge and really help you out with some great guidance along the way. So, Mitch and his team are great over there. If you want to find out more about Orrick, you can go to their website. It's orrick.com. So that's it for sponsors this week.
It's a good set of sponsors.
Yeah, no, they're great. And once again, if you have a question for us, you can call us 1-844-4FOUNDER, email us help@founderline.com, and tweet to @FounderLine. So let's dive back in here and see what we have coming here. Oh, here's one from Bill. This one says, why do you require your founders to be technical as opposed to having a mix of business and technical? Are there any drawbacks to having an all-technical team?
Yeah. So great question, and in fact, my criteria for this has actually subtly changed over the years. When I originally started, I used to say I only work with technical founders. But if you notice, this time when I described that criteria, and I said, and at least one person on that team has to be capable of being CEO. Right.
Got it.
And so that's kind of the slight addition of like, yes, I do want at least somebody on the team who does understand the business side, and it may not even be that they understand the business side right now, but they have both the desire and the ability to actually understand the business side, right?
Yeah.
And the person who asked the question is absolutely right that having an only technical team does have dangers with it, and I've run across this where sometimes you have a team that is highly technical, can build a great product, but they absolutely can't figure out what it takes to turn it into a business.
Yeah.
Right. And so so that's why my criteria has that subtle shift in it. That yes, I work with teams that are technical, and I kind of describe that as I want a team that can build its own product. Right. So what I don't want is, oh, we have this great idea, and now we're going to hire these two guys sitting in Russia or India or somewhere else, and they're going to build the product for us.
Right.
That totally doesn't fly.
Yeah.
So
yeah, it makes sense. Yeah, I've never had success with that. So
Right.
I know some people have,
Yeah.
but I don't know how to do that.
Yeah.
All right. Here's another one from Nick. It says, do you have a target percentage ownership? Are you more inclined to invest if there are 5 to 10 other investors you respect, or if you're able to take a bigger portion for yourself?
So ownership is an interesting thing. I really think about the ownership in a company more from, is it worth me spending time with that company? Okay. So that's kind of the perspective that I take. And so ownership to me is really defined by how much time I have and how much bandwidth I have. And so I only do about 4 to 6 new investments in a year. I expect those companies to kind of move to the next level within 12 to 18 months.
Okay.
And the way I came up with the 4 to 6 number is that the maximum number of companies I feel that I can handle at one time is probably about 8. Right?
Okay.
So I try and kind of be close to 8 plus minus or so, right? And so yes, I do try to make sure that if I'm going to invest in a company, I spend a lot of time with the company and with the founding team. And so I do want to make sure that I have a significant enough ownership stake for that. Okay. There was another part to that question that I've forgot at the moment.
Are you more inclined to invest if there are 5 to
right.
10 other
Sure.
investors you respect, or if you're able to take a bigger portion for yourself?
I am typically, I try to be first money into a company.
Okay.
And I do I do have a little bit of pride around like, yeah, I want to be the first person to kind of like discover this company, right?
Yeah.
And so so at the stage that I'm investing, it's typically me coming in as an initial like first institutional investor. If there are a lot of people already in the round, that honestly is a red flag to me. Okay, and it's a red flag to me because then it feels like a lot of people have come in without actually doing their homework, right? And I say that even from firsthand experience of where like one of the first investments I ever made, there was like it was a who's who of investors, right? And at that time I was a total newbie. I had no idea what I was doing, and I'm like, hey, this sounds great because there's all these like the great names on the investor list over here.
Yeah.
And so how can you go wrong, right? And within like a few months, I was like, doesn't look like these people really like dug into things as deeply as I would have liked them to. So so my style is more to kind of be to really dig into a company, into the founding team, do references on the founding team, make sure that I can work with them, that they can work with me, and move that way. So having a lot of people on board already doesn't really kind of it's it's not a positive signal for me. So
well, that's good. Yeah. In fact, it sounds like it might be negative. So. And what is there a number you like to own, or
it's not based on the number, because different companies have different levels of maturity, and so I do pre-seed and seed.
Okay.
So it's hard to kind of give an actual number there, but my typical investment amount these days is kind of, the range is between like 250 on the low end to about 500,000 on the high end.
Okay.
So that's kind of the range in which my initial investment lies.
Okay.
So. Yeah.
All right. Here's an email from Ted.
And actually, just want to clarify, on my website it actually says 250 to 750. That's kind of my theoretical range. But so far, the biggest check I've written has been just slightly higher than 500.
So that is, I view that as a challenge to all you entrepreneurs out there. Whoever gets the 750 first from this guy,
and I actually see it as a way of like, it's more of like, I'm learning how to do this as we go as well, right? And I started out writing $50,000 checks, right? And then I wrote a $100,000 check, and now I'm writing a $500,000 check, and it feels like a big jump. So I want to kind of make sure I'm comfortable with the company and comfortable with doing that myself. So.
All right. All right. So here's one from Ted. It says, it seems that seed stage investors have different perspectives on taking board seats. Mm-hmm. Can you please share your thoughts on this topic?
Sure. As I said, I'm a fairly active investor, and I do very few deals. And as such, I do believe in taking a board seat in the company when I invest in the company. And my reason for doing that is not about control. It's not about governance.
Yeah.
It's more about teaching founders what it means to actually have a board. Right? And where this came from is, like, in my first fund, I'd invested in a couple of companies, and then when the founders went off and did their Series A, I actually got a call from one of the founders saying, "Hey, I've got my first board meeting coming up. What do I do?" Right? And I'm like, "You've already been running this company for about 2 years. By this time, you really should have known what it meant to be working with a board and how all the governance and stuff actually happens."
Yeah.
So I kind of see a board at the seed stage as kind of training wheels, right? That's the time when you can learn what it means to have a board without actually having all the drama that can eventually come up with a board in the later stages. Right.
So you view that as your responsibility to
train the founders on what it means to actually have a board, right?
Okay.
And so that's why in a typical deal that I will do, there will be like just as an example, and these vary, but there might be like two common founder board seats and one investor board seat, right? So it's totally not about control. The founders still get to do what they get to do, but when it comes time for them to be issuing options, they need a board resolution in order to do that. Right. And that's critical stuff, because you don't want to mess around with that, because you'll end up in trouble if you do that wrong. So, yeah.
And in those cases, do you have formal, like, monthly board meetings, or?
Oh, no. Very rarely are there actually any formal board meetings.
Okay.
It's more of like, I have different schedules with different companies. Some companies I meet with on a weekly basis, some I meet with every 2 weeks, some I meet every month, some I meet every quarter.
Okay.
Right? So it totally depends on what the founders need. And what I say to founders is that it's up to them to make the best use of me and my time. And if they want more, I will have more time available. If they want less, I'll have less time available. And what I also say to them is, if I'm calling you, that's a bad signal, because that means that I don't know enough about what's happening in your company.
Interesting.
Right? So just keep me informed and get as much help as you need, or as little help as you need. So, yeah.
All right. Here we have another one. It says, with the recent Apple iCloud breach, are you comfortable having your fitness and health data in their cloud? Should we reasonably expect more security issues with cloud-based services when the value of the data is high enough? Interesting question.
So first, I think Apple was very careful to say that there was no breach of their systems. And it was more social hacking than an actual technical breach.
For the photo stuff that was going on.
And based on all the security and hacking type things that I've seen, usually it's like humans end up being the weakest link in the chain. So I do think that having information in the cloud kind of makes it more accessible, but it's a trade-off between usability and security, right? And the two of them kind of go hand in hand. Where it's very convenient for me to have stuff in the cloud, but I'm trading off part of the security portion of it, right? And so I'm not that concerned about. I'm concerned about security, but I feel that the utility that the services offer often ends up trumping the security considerations. But that said, the security considerations do need to be taken seriously, and humans need to make sure that they don't do the wrong things, right?
All right.
Yeah.
Sounds good. Here is another question from Mark. It says, what is your stance on startups offering early exercise, parentheses 83B, sure, to their employees? So it comes up a lot, right?
So great question, Mark. And I actually like the idea of offering early exercise to early employees. And I think it's just kind of a nice thing for companies to do for their employees. Right.
What are the limits these days? Are there some numbers that you tend to suggest, like don't go beyond the first 10 or 20, or just give it to everybody?
Well, the thing with the early exercise is they're exercising, but it's still restricted, right? So it's still, sure, if somebody leaves or then the company basically does a repurchase on those.
Sure,
right?
Sure.
So there's very little risk to the company from doing an early exercise. So yes, I actually encourage the companies that I'm involved with that, you really should do this, and you should allow your employees to early exercise.
That's great.
I think that's just my perspective. If Mitch was on, he might give a more legal perspective. I'm sure there might be legal nuances that I may not have accounted for, but in general, I totally encourage that, because I like the idea that people kind of get their cap gains clock ticking earlier, get into long-term capital gains. Why not?
Yep.
So,
The only thing I would add, Mark, is as a CEO, I used to give people a little speech before time, like, hey, I know it's only $3,000, but you could lose this money. Like,
That's
you need to understand that. And I can't give you legal advice or tax advice, because you work for me, but just understand a lot. You'd be surprised how many people don't fully get that. They're like, oh, well, I get that back, worst case. And I'm like, no, you don't.
No, you
like,
don't.
That's going to go to pay for the Odwalas in the fridge or whatever.
No, and in fact, just to expand on that, yes, so you're absolutely right about that. If you are going to early exercise, you need to understand that you're not getting that money back. And if the company goes south, that money's gone, right?
Yeah.
And in some cases, you may have tax implications as well to work with. For the company, that money ends up going to the company.
Right.
So companies should like that in general.
Yeah.
I think the reason why companies have not encouraged this in the past is because of the administrative overhead involved of keeping track of all of this stuff.
Yeah.
Right?
Yeah.
And so, and here comes a plug for one of my portfolio companies that's actually solving this problem. So the company is eShares.
Sure.
And eShares is basically doing electronic issuance of stock, electronic issuance of stock options, and they also allow you to exercise your options online. And the entire process, the entire workflow and the process is automated, so that there's no administrative overhead for dealing with that.
Oh, that's great.
Right? So,
and then they keep track of the cap table and
they
everything
keep track
else.
Of basically, if they have the stock is issued electronically, the options are issued electronically. They build a bottoms-up cap table that's always accurate. And anybody, if I'm a major investor in a company and I have rights to see their cap table, I can literally just log into eShares and see it right then. I don't need to be emailing the law firm to say, hey, can you send me this company's most up-to-date cap table? So,
and frequently there are errors, because somebody stayed up too late and made a typo or something on the Word doc.
You'd be surprised at how frequently that happens.
Yeah. Well, that's why that's actually a really really good good name. All right, here's another one that's for fun. What's the source of the name Canine Ventures? Are you a big dog lover, or I guess K could be, your last name, or what's the source?
Sure. So the politically correct answer is that I am truly a big dog lover, and so yes, that's kind of the origin of it. The non-politically correct answer is
that's the one we want. We don't care about the first one.
Is that most VCs are sheep, right?
And man, so you're herding the sheep?
Not so much herding the sheep, but I want to be the dog, and I don't want to be the sheep.
Okay. Oh, that's a good one. That will be on the website tomorrow, I'm sure. So make sure you tweet that out, all of you that are watching out there. All right, that's a good one. Here's another one from Alexa. When you invest, do you prefer convertible notes or equity, and why?
Yeah. So I only do equity rounds.
Okay.
I don't do convertible notes. I think notes started out in order to solve the problem that equity rounds used to be too convoluted and too expensive to do.
Yeah.
But it's just kind of like devolved from there into there's so many variations of notes that you don't even really know what you're getting into. So I kind of standardize all of my investments on the Series Seed documents.
Yeah.
And that way I know what's in those documents. And literally when a company's counsel kind of prepares those documents, I can just run a diff on them and see what they changed.
Yeah.
Right. So I end up doing equity rounds, and I just prefer that approach. Notes tend to be, there's like so many different ways, and founders, I think it's kind of odd to me that founders still believe that notes are founder favorable. That's a total misunderstanding that exists today, because investors are not dummies, and they've actually fixed all the stuff in the note terms that were not investor favorable.
Right.
And so notes these days actually have all kinds of little things in there which can potentially make them less favorable to founders. So I'm a big proponent of doing equity rounds, and I've very often walked away from deals just on the basis of they're doing a convertible note, and I'm not going to do that.
So a lot of the YC companies are uncapped convertible notes, right? So
well, YC's done a good job with the SAFE documents at kind of bringing the notes back to being kind of founder friendly.
Yeah.
Right. But then it's always a question of like how far does the pendulum swing? And I truly believe that if I'm going to invest in a company, I want to be sitting on the same side as the founder once I've invested in the company, right? The only time I want to be across the table is when I'm negotiating the terms for my initial investment. And after that, I'm on the same side as the founders. And I just believe that doing an equity round aligns those incentives just right, and you don't end up with misaligned incentives, which you very often do in convertible notes. So,
all right.
Yeah.
Well, there you go, Alexa. There's so get ready for an equity round if you're gonna pitch these guys. All right, here's one from Doug. When a company is struggling, how involved do you get, and how do you try to help them?
That's a tough
right?
question,
yeah.
And it's a tough question to answer, because in most cases when a company is going through tough times, that's when they don't talk about it, and they don't want their investors to talk about it either.
Yep.
So first thing is I always try to respect company confidentiality. Right, that's the number one thing where I don't want the companies to ever feel like I'm saying something about them that they have not approved, or they're really like it's their company. Like the founders should really control the message around the company.
Yep.
Companies run into troubles all the time, and there are founder quibbles. That's probably like one of the worst situations you can run into in a startup, is when you have like two founders and the two of them are butting heads. That's a terrible situation to be in.
Yep.
Right. There are companies that can run into problems with premature scaling, right? Where and I actually I have a blog post on this that I call the curse of overcapitalization. Right. Typically, when a company raises a large amount of capital, and VCs are just as much to blame for this, because they try to stuff the money down into the companies because they want to get their ownership up. And so now the company's got more money than it needs. They end up hiring people where they're paying them exorbitant salaries. The burn rate cranks up. But if the product misses the mark or the revenues don't come in, now you've got a high burn rate and you're running low on gas.
Yeah.
Right.
Yeah.
That's another bad situation to end up in.
Yeah.
So I do get very actively involved with the companies when they have any of these types of troubles, and part of that is that when I'm investing in the company, I have real skin in the game, right? And this is one of the dangers of having kind of the party round at the seed stage, right? So if you end up with 20 people who put in $50K each,
yeah.
right? In that situation, when the crap hits the fan, basically the investors can think in one or two ways. It's like, I only put in $50K. Do I really want to spend this much time on it? Right. And that's one reaction. Or if they truly believe in helping the company, they're going to start helping the company. But then they're still going to be thinking like, I'm doing so much work on this company, and I only have $50K in it.
Right.
So both ways it kind of doesn't work out. And it's
convertible debt, and I don't know what my ownership is.
That's right. And the M&A climate is such these days that acqui-hires almost don't result in any return to investors. Right? If they're lucky, they get their money back. And in most cases, all the money goes towards retaining the team in the company that it gets acquired by. Right?
Say they could get it.
So that's changed a lot also in the few years. So there's lots of tough times that a company has, and so when I invest, I'm putting in a sizable amount of money in the company, and I truly do believe in getting actively involved with the company and helping. So.
All right.
Yeah.
All right. We've got one here from Peter. It says, my lead investor is pushing hard to bring in a new CEO, but I don't agree with him. Any advice on the best way to handle this?
One of my favorite questions.
Have you ever been that lead VC who's pushing hard to bring in the new CEO?
I'm usually pushing in the opposite direction.
Okay.
So I believe in having founders as CEOs. I also believe that founders have a level of passion that no outside CEO is able to replicate, right? And really part of what I look at as my job is to help the founding CEO be a great CEO, right? It's not always easy to do. Not all founders are able to make that transition.
Yep.
Right? And even if they're able to make that transition in one phase of the company, they may not be able to make the transition in the next phase of the company, right? So Mark Schuster had this great blog post that I keep referring to on leveling up, right? He's like, at different stages of the company, the founder and the CEO truly needs to level up and get to the next stage.
Sure.
Right? And that's not always easy. So in this situation where you're saying you have a lead investor that's pushing to get a new CEO, first thing I'd say is that I typically don't try to push for getting in a new CEO. I'm much more comfortable bringing in somebody in a COO position, right, where they can kind of run the operations. They can kind of they know what it means to run a company, but the founder is still the person who's setting the vision and the direction of the company.
Right.
So I definitely prefer that approach, that if you yourself feel that you need help, that would be a great way of actually bringing help in, right? And if I were is it Alex, if I remember right?
This one was Peter.
Peter. So
yes.
If I was in Peter's position, I would basically suggest something similar to your lead investor, saying, hey, why don't we bring in this person as a COO, or bring in a person as a COO, but give me the chance and the opportunity to actually show that I can do a great job. Right? So,
that's great advice.
Yeah.
Oh, that's good. And you've seen that work in situations?
I have seen that work.
Oh, good.
I have seen that work, and I've seen the opposite not work, where the VCs have forced a CEO change and totally derailed a company for almost 18 months and burned a lot of capital in the process, and then eventually gone back to the founder and said, please come back and run the company.
Happens all the time.
Yep.
Happened to me.
Yep.
So those are bad situations. It's the grass is always greener theory, right? But
and I actually I don't remember if I finished this post or not, but I think I did. I think the blog post is called "If I Had a Hammer." And it's really about most VCs think they have only one tool in their basket, which is fire the CEO.
Yeah,
right?
yeah.
If the company's not doing well, what can I do? I can fire the CEO. If the company's doing super well, it's like, oh, we need a CEO who can really scale this thing. Fire the CEO. So yeah, I'm not a fan of the hammer tools.
You're a multi-tool investor, huh? Well, unfortunately, we're out of time. Thank you for joining us and being such a great guest.
My pleasure. That was a lot of fun. So.
Good. And you can follow Manu on Twitter. His Twitter handle is @Manu Kumar, and his firm is @K9 Ventures. Letter K, 9 Ventures. Tune in next week for another episode of FounderLine. Our guest will be Aydin Senkit from Felicis Ventures. Aydin's a great guy who's an investor in companies like Dropcam, Rovio, which is the Angry Birds series, Twitch, and Fitbit. It'll be a great show. It's next Thursday at 5 p.m. Pacific time. Thank you once again to our fantastic sponsors, Orrick and Ustream. Don't forget to follow us on Twitter. Our handle is @FounderLine. You can send us questions in advance for Aydin to help@founderline.com. You can go to our website and watch previous episodes, subscribe to our newsletter, and find out more about upcoming guests, as well as subscribe to our podcast on iTunes. Thanks for watching. Here's to the crazy ones, and we'll see you again next week.